Good morning or good afternoon or maybe good evening, depending on where you're located. This is the special broadcast of our initiative. I see Ivan is joining. So basically this event is organized by ITC alumni. And there is a saying that sun never sets on the British Empire. So sun never sets on the world of Kees van Raad alumni, because we are starting from Indonesia, and later on David Borinsky will be joining at 5:30 a.m. morning his time. So basically, we will be kind of traveling around the world. The purpose of this meeting is to update on Southeast Asian international tax developments in anticipation of Kees van Raad training, which will start on 24th of February. And we have distinguished panel of speakers, starting from Kees van Raad. I will not explain basically all the achievements, and you will have the option to learn it maybe more in Singapore and one of the events organized by Kees. Very briefly about our program. This going to cover several countries. We will have a case starting the presentation, and then we will have a presentation of Melani Devi Astuti. On Pillar 2, we have Indonesian colleagues' presentations, China, Hong Kong. Very remarkable list of speakers, very remarkable list of attendees. And last but not least, this is done, as I mentioned, in anticipation of Kees van Raad training. And we will be happy to see you at this event as well. So without further long introduction, I will pass on the word to Kees. And Kees' topic is to overview of general tax trends and recommendations on which subjects to focus in respect of studies to remain basically afloat, to remain aware of all these recent developments. So, Kees, the floor is yours.
Well, thank you so much, Roustam. I really want to congratulate you with this initiative and getting so many people involved in this in the special BEPS Academy seminar symposium. I'm really impressed. Well, let me first say I've limited time because later today I'm flying to China, where I will be teaching at Xiamen University, where some alumni actually of ITC are teaching, particularly Dong Mei Q, who was in Leiden maybe some 20 years ago, and she's now an associate professor there, and I'll be teaching a full week course on tax treaties. And when we mention tax treaties, if I go back that's a long time before all of you were born, I think. If we go back to 1975, that's when I started actually teaching in Leiden. I taught there for 10 years, trying to get some interest in tax treaties off the ground. It's difficult to believe, but tax treaties or international tax law in general at that time was not a topic that was typically included in the curriculum, even of tax programs. I was in Leiden a student in the first full-time tax program, 2 full years of tax. And can you imagine, at the time, international tax was simply not a topic. And so one of my tasks, because I had a background in international tax law, having studied that in the United States, having worked in Holland in the international tax affairs department of the Ministry of Finance. So one of my personal tasks was to get interest in international tax law off the ground. Well, it took me quite a while. In '86, now almost 40 years ago, I was appointed to the chair of international tax law, the first chair in Holland and the first chair, I think, in Europe on that specialized topic. And well, that went well. I would say the era between 86 and the turn of the millennium was the era where international tax law in general and tax treaties in particular enjoyed an enormous lift in interest and also knowledge. I mean, when I just had become a professor in 86, I remember I was teaching courses at various law firms where even the leading partners had little clue about tax treaties. And that all was going to change in the next 20 years to until the beginning of this millennium. But quite interestingly, I would say some 10 years ago, when BEPS was introduced by the OECD and further developed, the interest in tax treaties has dwindled a little. You saw in practice, understandably, an increasing interest and focus of practice on all the avoidance techniques that have been used so far and the ways countries, on the initiative of OECD, decided to adopt various measures to restrict that. And what I see now, and it's both true in teaching in law schools in Holland, in law schools in Europe, in law schools globally, I would say a reduced interest in the sort of the hardcore technique of tax treaty interpretation, tax treaty understanding, and the application of the treaty rules to complex issues that arise in practice. And that's sort of, I want to focus my introductory remarks on that a bit. Tax treaties were never simple. I've been teaching them in Leiden for many years, both at the law school and at the ITC. I've been teaching them in practice, and every time again, it takes quite a while before people who are usually well versed in domestic tax law, interpretation application, sort of learn the treaty language to fully understand and be sort of comfortable with that, and to use that language in their daily practice. And I refer to concepts like permanent establishment, which has been around, for over a century, a topic that some people thought was going to disappear some decades ago. They thought that operations in foreign countries would take the form increasingly the form of subsidiaries instead of permanent establishments. But that was in the old idea that a PE was necessarily something like, a built structure through which you would conduct business operations. And the whole idea that if you have employees operating in a foreign country for your company, that those employees may trigger a permanent establishment was simply not sort of within the perception, within the horizon of the old ideas about permanent establishment. So this requires a ongoing, deep-going knowledge and understanding of how these rules work. I refer to triangular cases where treaties may interact. I refer to increasing issues of cross-border employment, where in the old days you would not easily see the patterns that have developed in recent years, where people for longer periods work in a different country from the country where their employer is residing. If you think of a company which is based in Singapore and a company with perhaps development centers in nearby countries like Indonesia or India, and is providing services worldwide to clients around the world, how's it going to work? What if they're going to set up a treasury center somewhere in the region? How are you going to characterize all these payment structures, the income earned by the people working for that company as an employee, working for that company as an independent contractor. All these issues require a thorough knowledge of tax treaty law. Last year, I think it was in March of 2024, I was invited to give a seminar to the administrative chamber of the Supreme Court in Indonesia. I happen to know one of the justices there, and he had organized that I would give this seminar for his fellow justices at the Supreme Court. And that turned out that there was a growing awareness also in branches of government where tax knowledge in general and tax treaty knowledge in particular is not very deep going yet. There's a lot of work to be done by by us in our practice, but also to be done to the extent you are called on to help out as a teacher in this area. So I really want to express my appreciation of your interest in this matter. I've been in love, with international tax law and tax treaty law for many years, and I do hope that you by now share a bit of this interest, this dedication I have to this particular branch of law. Many issues that have been around for a long time, as I explained a little earlier, are still here, and they're changing form sometimes. So things that we learned in one particular way may appear in a slightly different form in other ways. I'm thinking of an issue I dealt with recently, and that is an issue of the interaction between domestic tax law and tax treaty law. It's a basic, fundamental issue. The basic rule is quite simple. The practice can be quite complicated, particularly when in tax treaty applications, the treaty allows domestic law definitions to enter, domestic law definitions to be used in treaty interpretation, and the question arises, what are there any limits to the application of domestic tax law? Is perhaps an issue when a particular domestic tax law rule was made as compared to the date that the treaty was concluded. What are the fine points there? Well, there's surprisingly little written about that. It's something that you have to be familiar with from earlier learning, from a few cases that have been decided. It is one of these areas where I think in the years to come will become increasingly important, because countries are more and more aware of the treaty effect on the application of the domestic tax law, and thereby how they perhaps can shape the way the treaty rules work from the perspective of their own law. Anyway, I've been talking already for 10 minutes. Why don't I create a little time for you if you have questions that we may discuss together. So, Roustam, why don't you take over from me for a minute to see how we can continue this discussion?
Yeah, sure. I understand that you are very tight in terms of timing and you cannot stay long. I would suggest Melani, Ivan, who I particularly want to thank for supporting this event, to give the opportunity to ask Kees a question. If you do not have any immediate questions, I will ask one. But I would like to give you this opportunity. Okay, so my question, Kees, when you gave very excellent remark in Cancun Congress in Mexico in respect of what's going on. At present, everyone is, well, not really horrified, but kind of confused after the recent announcement of the new US administration that they kind of say, okay, guys, you do whatever you want, and we go our own way. So what's your forecast? What's going to happen in the next few years? And what we should be focusing on in respect of kind of analysis and studies, and what we should be prepared for as tax professionals?
Yes, yes, yes. Of course, from a great many perspectives, it's very sad and upsetting what's happening right now in the United States in general, and the consequences the new presidency has for developments in the international tax area. I'm particularly thinking of the OECD 2 pillars, two extremely important pillars. Of course, Pillar 1 has already been sort of in the background. Chances that Pillar 1 would be adopted anytime soon were quite remote and are perhaps now, off the table. United States in the past few months already was quite noisy in respect of the Pillar 2. To what extent were they willing to adopt their own domestic rules, which to some extent have been sort of the example for the OECD to shape the Pillar 2 rules? To what extent were they willing to adjust these rules to the format agreed upon within the OECD? But this perspective of also Pillar 2 likely not being implemented around in the world makes it quite upsetting how things will develop. Our countries indeed going to adopt at a much broader scale than we have seen now digital service taxes, as the EU has threatened to do when there is no agreement reached in at the OECD level, and also in other areas when the United States sort of stops being willing to, through discussion and agreement with its global partners, arrive at common solutions. It's very difficult to predict at this stage how things will be, let's see, 1 or a few years from now. But things will undoubtedly become more complicated and controversial. So it would be sort of an ironic perspective to say, well, confusion is always good for tax advisors, because it means, a lot of uncertainty, a lot of business perhaps to help out clients. But this, of course, would be a very, very sad development. But I'm afraid it's going to be realistic for the years to come. So that's okay. A shorter answer. Maybe I may add at this point that although I've been in international tax law for many, many years, one of the reasons I keep so much involved and enthusiastic about it is that, different from other areas in law, what I see is because of the changed circumstances, the subject never remains the same. Of course, it's quite well and broadly understood that if a person who is in international tax law practice, if a person would, let's say, on a would take a break, a 1 or 2 year break, and come back after 1 or 2 years, you have to almost, start for at least half of the knowledge you had earlier to update yourself. It's going to be quite a while before you're sort of, back in your ordinary comfort zone, knowing everything what's going on. One of the fascinating things of international tax law is that it keeps challenging. As I told some of my students in Leiden, never a dull day in the life of an international tax lawyer. No, something going to be happening often. And also myself, I sometimes while teaching, or sometimes when I'm writing, I find answers to issues that I ran into before. I was never really able to deal with those issues adequately. Let me give you a little example. It's a well-known issue that if a taxpayer, typically a company, resident in one country, owns real property in another country, and derives income from this real property, the property is not going to be used as, let's say, the office of a branch operation. No, it's holding property that is rented out. Can you say that the property itself, which typically could be a permanent establishment, because it's a fixed thing, it's going to be available, it's going to be at the disposal of the company, is that indeed a permanent establishment? Or put it differently, what are the particular tests you have to apply to figure out whether such a building in the other country is going to be a PE? Let me first say that some people may say it doesn't make a difference, because whether or not it's a PE, the income, if a PE is going to be taxable under Article 7, if it's not a PE, it's going to be taxable under Article 6. Well, that may be true, that is true, but whether you're going to be taxable under Article 6 or under Article 7, the rules that operate in these two different articles can be quite different, depending on the type of operation you have. Article 7, business, profit, determination rules are quite different from the Article 6 rules. So it does make a difference. So what is the point where a piece of immovable property becomes a permanent establishment? I was never fully able to get my finger behind that concept. I would typically say, well, if you rent out a building and you don't do anything else in that country, then just owning the building and probably having a local agent that collects for you the rent, and that's going to be it. That is not a thing that makes that building a permanent establishment for you. I now think that the real test, and I haven't seen that in case law or in writing or so, the real test is whether the activities that you carry on through that building, the reason why you have that building, is it an activity that typically fits into your overall business activity? Is there something, for example, if you are a real estate management company, then managing a building is part of your ordinary business activity. But what if you're manufacturing pharmaceutical products and you happen to own a building because maybe you had operation in that country and you gave it up, but you still kept the property of the building and you get rental income from that? So the basic question is the function of that building, and thereby the nature of the income derived from that particular investment. Is that part of your ordinary business operation? And of course, that may lead to further questions, but that, I believe, now is sort of the basic rule that will determine whether Article 6 or Article 7 may be applicable. In any event, I just want to give you a little illustration why I still like so much international tax law, why I am speaking to you this morning, why I'm actively engaged in international tax law, why I'll be leaving later today to go to the Far East to engage in teaching. And I very much look forward to that. And I really want to thank you, Roustam, for the opportunity to speak here at the beginning of your seminar this morning.
Well, okay, so this is really the joint effort. I just facilitated this, but I'm really honored to be part of this community, which brought us together. And this is basically your studies at ITC Leiden, which you organized. And I'm very happy that I became part of this community and remain part of this community. And this is a privilege to be part of these discussions, for example. So once more, those who are located in Southeast Asia, you have chance to join the live training of Kees van Raad. And you saw how it is entertaining to some extent, and I always loved the way how Kees could explain very sophisticated matters in simple language with a very good piece of humor and very involving and encouraging. This is QR code. We asked to extend registration for this training specifically until very late day possible, and this very late date is today. So if you scan QR code, you will get to this web page. Just familiarize yourself. If you are not sure, just file the application. The payment matters will be dealt later on. Well, with this, I would like to thank Kees for joining this discussion. We will continue further with Pillar 2 in particular. So Melani Astuti is going to deliver a presentation on this. We wish you a safe trip to China and Singapore. Happy teaching, and I hope to be part of one of the live events with your participation in the not too remote future.
Okay, but thank you so much, and thank you also participants. I hope to see you. And all the best. Okay, take care.
Thank you. Thanks. So we can move forward. I would like to introduce presentation of Melani Astuti, Melani Devi Astuti. Melani is a very knowledgeable tax expert. I was very much impressed with her presentation at Berlin IFA Congress. Also very sophisticated matters delivered in a very simple, very plain language. And we asked Melani, who holds position as Senior International Tax Analyst, Fiscal Policy Agency of Ministry of Finance of Indonesia, to update on implementation of global minimum tax in Indonesia and what a foreign tax expert should know about current state of affairs in this respect. So Melani, the floor is yours. If you need any assistance with the slides, please let me know, so I will just turn them on.
Thank you, Roustam. Good morning, everyone. I'm Melani. Let me share my screen.
Bu Melani, suaranya kurang keras, Bu Melani. Sorry, can you please, I mean, speak louder because I cannot hear very well.
Sekarang is it clear now?
Yes, yes. You can just unfold the presentation because now we see it in a...
Okay, wait. Okay, so today I will present about the implementation of Pillar 2, not limited to global minimum tax, but also the SDTR, because Indonesia has signed the MLI on SDTR. I'll start with the global minimum tax. This slide shows the top 10 of Indonesia FDI origins. So in the slide, you can see that in the top is Singapore, is the biggest investor in Indonesia. And then China, Hong Kong, Japan, Malaysia, US, South Korea, Netherlands, BVI, and Australia. But if we based on our analysis, the most impacted on the GMT investors are coming from Japan and Korea, not Singapore. Singapore is our top investor. If you see among those 10, many of them implemented the global minimum tax from 2024, which are Japan, and then South Korea, Netherlands, and Australia. Singapore, Hong Kong, Malaysia will implement the global minimum tax in 2025, while the others not implemented yet. Okay, and this is the implementation of global minimum tax across Asian or Southeast Asia. We can see Vietnam is the first adopter in Asian, because Vietnam has implemented in 2024. And with regards to the incentive, Vietnam introduced the cash grant, which is so-called investment support fund for high tech. And then Indonesia implemented the MTT and IIR from 2025 and UTPR from January 2026. No new incentives are introduced yet, but the government considers to introduce the new incentive that more compatible with the global minimum tax. With regards to the tax holiday, Indonesia has extended the tax holiday until 31 December 2026 and has added one provision that said that the recipient of the tax holiday, which is in scope of global minimum tax, will be subject to global minimum tax, for example, the DMTT. And then we can see Singapore will also implement in 2025, and Singapore will introduce QRTC in the name of refundable investment credit. And Malaysia also implement in 2025, no changes in the current incentive, but they plan to introduce QRTC. And Thailand will also implement in 2025. They have modified the tax holiday regime from 100% exemption into 50%, but the period will be extended twice, maximum 10 years. And no new incentives are introduced yet. And now I will go more specific to Indonesia. As I said before, we apply the MTT and IIR from 2025 and UTPR from the 1st January 2026. Among Asian countries, only 2 countries apply the UTPR, which is Thailand and Indonesia. If I'm not mistaken, Thailand will apply the DMTT, IIR, and UTPR at the same year, 2025. So in here, Indonesia still have 1 year time before the UTPR is implemented. For the DMTT, we apply the DMTT for the global turnover 750 million euros, just like the threshold in the model rules. And the ETR, the globe income, will be calculated based on the accounting standard of the UPE, or the Consolidated Financial Statement. And the payment should be made in the Indonesian currency. And the tax will be allocated only to the constituent entities in Indonesia, which has effective tax rate below 15%. So if Indonesian CE has ETR above 15%, it won't have to pay the DMTT top-up tax. And it will be applied for all CEs regardless of whether they are owned partially or wholly by the other member of the group. For the IIR, Indonesia applies the IIR consistent with the model rules. And for the UTPR, the rule doesn't adopt the denial of deduction approach, but we just impose the direct tax based on the amount of top-up tax. And we have 3 tax return, and I will present. This is the timeline of the implementation in Indonesia. 2024, we have issued the rule that will be effective from 1 January 2025 for the IIR and DMTT, and 2026 for the UTPR. Now we are disseminating the rules to the taxpayers, to the businesses, consultants, and etc. We are also preparing the review process because we have to submit it to the IF by March. And we also improve our IT and administration system. And in 2026, the UTPR will be applied, but still we have 1 year. We still have time to reviewing our UTPR because of the US position. So maybe we need time to consider whether we will remove the UTPR or not. We will see how other countries react. And in 2027, this will be the first year of the first GIR and notification filing. We will also have the globe tax return and then the exchange of the GIR. And in 2028, we expect to have audit. So we need to do risk assessment, compliance risk assessment. This is our timeline for the implementation of GMT. And these are the 3 reporting obligations. The first is notification. It should be submitted by all Indonesian CEs. except for the CE that already have the obligation to file the GIR. And the second is the GIR. It shall be submitted to the tax authority 15 months after the fiscal year ends. Also the notification. It should be submitted by the Indonesian UPE or Indonesian CE, in which the MNE group appoint Indonesian CE as the reporting constituent entity, or the reporting constituent entity is a resident of a jurisdiction without a qualifying competent authority agreement with regards to the information exchange at the reporting year. And lastly, the tax return. We have 3 tax returns. So the first is the globe tax return. It should be submitted by the UPE. And then the DMTT tax return, it should be submitted by the Indonesian CEs. And lastly, the UTPR tax return, it should be submitted by Indonesian CE only if there is the UTPR allocation to Indonesia. And this is the payment and reporting timeline. So let's say for the first year, the MNE group falls within the scope of GMT. Let's say it's fiscal year 2025. In 31 December 2026, the payment should be made. It is maximum time to make a payment for the GMT obligation. And then in April, the tax return will due. But considering the extension of the GIR, which is 18 months, so it will be in 30 June 2026, then the tax return can be submitted 2 months later, which is also 30 June 2026. So in 30 June 2026 will be the due for the notification and GIR, and also the tax return for the implementation of global minimum tax for fiscal year 2025. And subsequently, the normal period, let's say in 2026, the payment should be made at the latest 31 December 2027. And for the reporting of the notification GIR, will due in 31 March 2028, or 15 months after the fiscal year ends. And the tax return will due on 30 April 2028. Sorry, not 2026, but not 2027, but 2028, because it's the due also for our corporate tax return. We also adopt all the safe harbor, the de minimis, and then the UTPR safe harbor, CBCR safe harbor, and simplified calculation. We also expect that we will get safe harbor QDMTT so that we can also apply this safe harbor, because it is based on the review conducted by IF, based on some criteria, for example, accounting standard and consistency standard. And now this is about the SDTR. Indonesia has signed the MLI on SDTR on 19 September 2024, together with 8 other countries: Barbados, Belize, Benin, Cabo Verde, Congo, Romania, San Marino, and Turkey. And in the signing in the MLI, we add 29 tax treaties to be covered by SDTR MLI, because based on the OECD survey, these treaties will be impacted if Indonesia apply the SDTR. As you can see, we can also have we also have Singapore here. So if MLI SDTR applied, the Indonesia-Singapore tax treaty will be impacted. However, this MLI required a ratification through a presidential decree. And when will it be entry into effect? Well, commonly it takes 2 years for the government to ratify the international agreement. yeah, I think that's it. Maybe I just can summarize for the impact for Indonesia, Singapore transaction. Let's say the payment is made from Indonesia to Singapore. For the SDTR covered income, so there will be potential SDTR top-up tax. Let's say for the rent of the industrial, commercial, scientific equipment, there will be potential 1% top-up tax in Indonesia. And for the distribution right or services, there will be 9% top-up tax. But reciprocally, if there is payment from Singapore to Indonesia, there will be no impact because Indonesia applies 22%. And we don't give any exemption or special rate under 9% for the SDTR covered income. I think that's all, Roustam. I get back to you. Thank you.
Thank you very much. Thank you very much, Melani. Very informative, very useful, and this is actually the format which I welcome very much. So very sophisticated matters explained in plain language in main points. I'm not sure if we have time for the questions because we are slightly behind the schedule. I would like to thank you once more for joining this discussion. I hope to have you as one of the prominent speakers in our subsequent events. I hope to make these meetings of ITC Leiden alumni and friends, let's say friends of ITC club more regular, and we can move ahead then. So thanks again.
Thank you, Roustam. I have to go because I have another meeting. Thank you for inviting me. Bye.
Yeah. Now we move further, and I'm specifically honored to invite my friend and also ITC graduate, Ivan Sukardi. Ivan Sukardi is managing partner tax of RSM Indonesia and very active member of international tax community in Indonesia and beyond the borders of this country, very active for organizing various events. And again, I'm very grateful to Ivan in particular for helping to organize this event and coordinate lots of things. And we decided to speak quickly about such topic as beneficial ownership. In this respect, Ivan, may I just ask you what would be the main, let's say, points to know about Indonesian approach to this subject? What are the priorities, let's say, of Indonesia in terms of interpreting beneficial ownership and other international tax concepts? For example, from perspective of UN and OECD model commentaries and clarifications. So basically, what's the Indonesian approach in this respect?
Yeah, thanks, Roustam, for the opportunity to speak this in this, I think, great preparation event. One thing that I may need to emphasize that the training organized by ITC Leiden and Singapore Tax Academy is probably one of the best forum for participants to discuss and to understand more on the treaty, both concept and also practical and application. What is relevant for Indonesia, because you raise specific issues on beneficial owners. So Indonesia, say, start with the domestic tax interpretation. So it started a long time ago. So we don't have specific definition of beneficial owner concept. But I think to some extent we can start that the definition itself provided by the tax authority based on their interests. So regardless of the concept may not be consistent with the treaty concept itself, but we have to admit that that had impacted to some say transaction and also a taxpayer itself when they enter into a transaction and when the tax authority say enter into to review the transaction and come up with different concept of beneficial owner. And I think the most important part is when we had a regulation issued in 2009. So that's probably the best period, and I think the closest concept to the what is meant by beneficial owner by the OECD model commentary. But then to some extent, I think we've been discussing this issue as well, that it put more restriction on the application itself. So then this created a lot of tax dispute. So basically, there's a form required by the tax authority if you were to apply the treaty benefit, and then you have to fill in the information. And that later on the form itself is amended or simplified in 2017 and 2018. But what I was trying to say here is, so life is normally not as difficult as it's promised. So in practice, then the application and when it is interpreted by the tax authority, it is very difficult for you to say convince them that this is the what is disclosed in the form. So basically, it is the actual fact. So they will likely to challenge. But in 2021. The Indonesian Tax Authority issued guidance on the guidance in implementing the provision of the tax treaty. So basically, it is a guidance addressed or intended for any say tax authority in interpreting the tax treaty. So it is issued December 2021. But the main point, what is I think it is a good step for them. So basically, they acknowledge that the treaty model, there may be some part follow OECD or UN model or based on the bilateral provision. So when they have to interpret the treaty itself, so it is suggested that they have to see the commentary. So basically, they acknowledge. And one thing that is, I think as a result, and I understand there will be maybe Arsono will cover some study case on the treaty. But what is interesting to note is based on some developments of the dispute on tax treaty, especially beneficial owner, that Indonesia and Netherlands treaty later on after the 2015 protocol include some very interesting provision. But I think we can find the similar provision in other treaty. But I think my understanding that this is also the first provision in the Indonesia treaty signed with the partners to include the official statement that if later any dispute or whatever both parties need to interpret the treaty provision, then if it is similar or identical with the OECD model, then it has to be interpreted what is written in the commentary, which is at the date of the sign of the treaty was signed, or later on the amendment. So it basically follow the ambulatory approach. So this is I think the recent development of the beneficial owner terms under the Indonesian tax rules. So hopefully in the future, we have less dispute on this issue, because I think the most important part for the investor or the taxpayer is the certainty in say basically applying tax regime. I think that is from my side, Roustam.
Well, thank you very much. Thank you very much for this comment, Ivan. I tried, when you mentioned the program and training, I tried to go to screen demonstration, and somehow I chosen the wrong set. So let me fix this mistake and show you the right screen. So as Ivan recommended, and the next speaker is attendee of this program, Mr. Arsono. We we recommend those who are in the region to seriously consider engaging in this training of Kees van Raad. So he left us to go to proceed with preparation for this program in the region. And the process is very simple. Either scan QR code or just download brochure from the chat of this discussion and simply register. That's pretty much it in respect of the comments of Ivan. We can proceed further. And if Mr. Arsono is prepared to give comments on beneficial ownership, maybe followed also some comments by Ivan and other participants from Indonesia. Actually, to our attendees, there is a web chat. You can just type your questions, comments there. You can post questions in section of questions and answers. We will try to pass on to the speakers when we have time for this. And it's also interesting to follow, let's say, the history of developments, because what Ivan just mentioned, the specific reference to OECD commentary, might relate or might not to some Indonesian jurisprudence on beneficial ownership involving the Dutch companies. So Mr. Arsono kindly shared with me the judgments of Indonesian courts. It was in Bahasa language, so I just translated them into English. And very interesting to see. So when you keep in mind all these developments, and you know that protocol referred to OECD commentary after just time-wise after some Indonesian jurisprudence, this might give concern, give a presumption that maybe the Dutch Minister of Finance had some questions in respect of the, let's say, these court rulings. So everything is kind of related pretty closely. Anyway, enough for the comments from my end. Mr. Arsono, I would like to introduce your part of the presentation, and T. Arsono is also very knowledgeable, very well-known Indonesian and international tax expert with background of studies in Belgium, in Leuven University in particular. Mr. T. Arsono is managing partner of Amadea Kila Indonesia, our firm, and very active member of AOTCA. AOTCA is a union of Asia Pacific tax consultants. So, Mr. Arsono, I would like to give you the floor and listen to your comments on these beneficial ownership cases.
Okay, thank you, Roustam. Good evening, everybody. I think there is 5 or 6 people here in round table. From Indonesian perspective, beneficial ownership concept is very interesting. It's why? Because when we talk about beneficial owner, So we always remember about the Indo-Food International Finance, that according to me, it is a landmark case in Europe. And then similar with the Indo-Food International Finance, in respect of individual ownership case in Europe, let's say after 3 years after that, we have a similar case in Indonesia. And also the name is very similar. We call it Indusat. Indusat is about telecommunication company, and then they want to acquire a satellite to support their operation in Indonesia. It's why they need additional capital to support their expansion, and then they establish a company, not in Mauritius, but in Netherlands. So we call it, the subsidiaries call it Indusat Financial PV, that established in Netherlands. On 2003 and 2004, there was a dispute between Indusat, debtor of the Indusat Financial PV in Netherlands, in respect of the application of withholding tax rate in Article 26, because according to Indonesian domestic rule, if the recipient of the interest income is not considered as resident of the Netherlands, so 20%, according to Indonesian domestic rule, 20% was applied. Because based on administrative perspective, all administrative requirement, what we call certificate of domicile, has been provided by Indusat Financial PV of the Dutch company to the debtor. So according to Indonesian company, Indusat Perseroan Terbatas in Netherlands, we call it Indusat NV, Indusat PV, they're entitled to reducing withholding tax from 20% to 10%. So they withhold 10%. So this is very unique of Indonesian taxation authority. Even that all requirement has been submitted to the authority, they agree with that, and then they decided, no, Indusat Financial PV, a Dutch company, did not entitle to the treaty benefit. That means reducing withholding tax from 20% to 10%. That's why Indonesian Taxation Authority issue what we call it tax collection letter. So there is a dispute. There was a dispute between Indusat as debtor and Indonesian Taxation Authority, and then they go to court. This is very interesting, based from the argumentation from each party. Because on 2004 and 2003 and 2004, in the same dispute, the Indusat lost the cases, and then based on the same argumentation, they provided on 2003 and 2004, they applied 2007 and 2008 and 2009. Anyway, there is a little bit different from the structure of the board of management of Indusat Financial PV, a Dutch company, that according to the fiscal year 2008 and 2009, there's a changing of the structure of management of the Dutch company, in which of the debt, 50% of the managing director, of the director of the company is a Dutch, and then from the equity requirement, they meet all Dutch requirements. So considering the all fact they have, as the Dutch company, the judges decided that Indusat Financial PV of Dutch company is deemed as beneficial owner of the income of interest. So because they deem as Dutch resident, so they're entitled for reducing withholding tax from 20% to 10%. this is very good decision, I mean, in favor of taxpayer. But we have a look at other cases. In principle, the structure is very similar. It involves of the electrical state-owned company. The structure of transaction is very similar with Indosat. They established new company in Netherlands because they want to expand their business. They require any additional, capital. They issue a bond to international market, and then all of the requirement has been made, like certificate of domicile, because there is an obligation for what we call the company in Netherlands, we call it Majapa Financial PV, because there was an obligation for Majapa Financial PV of the third company to transfer directly the interest income from Indonesia to the creditor in international market. And then, according to the fact, the court decided that Majapa Financial PV is not beneficial owner of the interest income. So, the recipient of the interest income is not entitled to reducing withholding tax from 20% to 0%. So when we consider the two cases I presented to you, it's likely that the decision of the court is not consistent with one to each other. I think this is from me, Roustam. Thank you.
Thank you very much. Thank you. May I ask a question? So when I read the court decisions,
Yep.
to me it seemed to be so liberal, like a reference to foreign country, because of course, if there would be reverse situation, of course, the Dutch court might pay attention to definition of what is the substance, let's say, in Indonesia.
Yep.
But in the end, it will be the Dutch matter. So it will be Dutch understanding of what is the sufficient presence, what is the... So why do you think the Indonesian court was so, liberal in a positive sense to say, okay, basically outsourcing, defining what is taxable, what is not under Indonesian rules to the foreign jurisdiction?
Well, I think the term liberal is very good, but according to me, it's not so liberal. But, there is no standard pattern how to decide it, what the meaning of beneficial owner. The second one, because the judge, one to the other, is independent. So sometimes the interpretation of beneficial ownership by one judges, another judges, it's not consistent. According to me, it's create like, uncertainty, what the meaning of beneficial ownership. This is very, it's very challenging to assist taxpayer in Indonesia in respect of beneficial ownership dispute.
Okay.
Thank you, Roustam.
Okay. If I may ask one more question, maybe Ivan or Bobby or Yemin would have comments or questions, because we still have time for some questions, answers. To make it more interesting, more live, because I always appreciate the opportunity to speak to foreign colleagues, because interpretation is always different in every single country. Would you have any comments or questions?
Yeah, Roustam, if I may, I'm doing my research on especially not only the beneficial owner, but mostly this is in relation to the passive income, and to some extent, I have categorized the Indonesian tax dispute on passive income. In addition to beneficial owner, they include also the characterization of income. To some extent, it is the payment is, say, under royalty. but then later on it is categorized as a dividend, or but then in that case, both will constitute the withholding tax. But to some extent, to some cases, so for example, the payment is in relation to services, so the support from affiliate. So under the Indonesian domestic tax rules, payment to say non-residents subject to withholding tax at 20%, but later on the treaty may to some extent exempt, provided that no PE in Indonesia and then no tax is payable in Indonesia. But then the tax office considers that this is excessive payment, and it is considered as a dividend because it is paid to related parties. And if it is dividend, then the payment itself is not considered as expenses, tax deductible, and there will be withholding tax. So I haven't completed the research, but in addition to say beneficial owner, the recharacterization, and also some other forms of interesting finding, we'll share later on in the probably in the separate session. Thank you.
Okay. Thank you very much. Yamin, may I ask you, well, of course, this is pure hypothesis, but you are very strong expert in Chinese international tax jurisprudence and disputes resolutions. So how would you comment from China jurisprudence perspective these Indonesian cases?
Sorry, because currently I also at the same time I deal with other issues, and so I didn't pay a lot of attention to this case. So the comments from my side, currently I can't give. Sorry.
Okay. No problem. But you will be doing the presentation on Chinese jurisprudence.
Yeah, sure.
And we'll ask a couple
later. Yeah.
Good. And Mr. Arsono, thank you very much for this excellent presentation. I know that you attended this training, specific short-term training, which is being repeated this year. And what would be your comment? Who should be considering joining this training, and for who this might be just, let's say, too easy or too simplistic? So who would not benefit from the training, which we were discussing today?
Well, this my, I regularly join the international training and taxation, because tax law is very interesting for me. So when there is a qualified training in taxation, I'm sure I will join with it. Well, based on my experience joining with the international tax law with Singapore Tax Academy, of course, Kees van Raad and Sid as a instructor in there. What I suggest is we invite more higher level position of the participant.
Okay.
So the discussion not only based on from the theoretical aspect, but also from the practical aspect, especially from Indonesia. So I'm sorry to say, Ikhwan has good position now in Indonesian Tax Consultant Association. So I do require Pak Ikhwan to, inform our member to join with international tax law in Singapore.
Okay. Well, I'm pretty much Ikhwan.
Well, hold on, because last year I also joined with the Singapore Tax Academy, and then we already informed Indonesian Tax Consultant Association to inform our member to join with it. But for international, for higher level, so the class will be it's more interesting, and we get many benefit from not only from the theoretical aspect, but also from practical aspect, from not only from Indonesia, but from also Singapore, from China, maybe from Netherlands, maybe. It will be very useful for us. It will be more interesting. Thank you.
Okay. Well, thank you very much. I'm just scoring down the content of this 1 week training, and interesting remark, because sometimes it is perceived as a training focused on junior consultants who are just making first steps. And we saw very senior, very knowledgeable, very experienced tax expert recommending this course as having been attended by himself. I mean, Mr. T. Arsono, and I just leave it here for a minute for you to be able to scan this code and apply if you decide this will be beneficial for you and your colleagues. Meanwhile, we are slightly ahead of schedule, and I'm just wondering if Bobby is prepared to intervene with your presentation on transfer pricing developments.
Sure.
Okay, good. So
That'll be fine.
Then we can just move ahead with the presentation of Bobby, and I will just quickly introduce Bobby Savero. Bobby is also Leiden graduate, experienced consultant, advisor at Tax Prime Indonesia, and Bobby will cover transfer pricing developments in Indonesia. From perspective of foreign consultants, this is the point. So what foreign consultants should know about these developments.
Great. Thanks, Roustam, for the introduction. And of course, thank you very much for the opportunity for me to speak. But firstly, I would like to apologize if my presentation today is not as I planned and expected, because my grandmother has passed away this morning. So it's a blow for me. It's a blow for us. So, but of course, commitment is commitment. I appreciate you very much. And that's why I will still present whatever I can present, and just please ask whatever you want to ask with regard to transfer pricing regime in Indonesia. I will be very happy to have a discussion in this seminar or later. So can I show my screen?
Yeah, absolutely. There is a green button. First of all, please accept my deepest, sincerest condolences in respect of this loss. So that's very sad indeed.
Thank you. Thank you, Roustam. Appreciate it. So I'll start. So I will talk more about the transfer pricing regime, but this presentation is actually designed for just a very quick glance of the updates of Indonesian international tax and transfer pricing regime. So I will start with the background. So what I believe you already aware with this, but it's very important to still touch the ground and the background of Indonesian relation to the Southeast Asia economy and Asia economy. So after the COVID-19 recovery, Indonesia remains an emerging jurisdiction with the projected economic growth still around 5%. And this economy it's quite good compared to some jurisdictions. We just had a new president sworn in with a very ambitious program, which makes the state budget requires another 10% additional tax revenue. So I just want to provide a context that the Indonesian Tax Authority currently could be understood to be in a quite high pressure to achieve the 10% additional tax revenue target. And then in addition to that, we also had a mega project, new capital city. And so the previous president actually planned and started the new capital city project in Kalimantan Island, which requires a lot of funds to build. That is why that also in addition, on top of the ambitious program of the new president, it's also put into the great mix of the need of additional tax revenue for the country. I also want to touch the ground a very unique relation between Singapore and Indonesia. Well, as a matter of fact, Singapore is actually one of the largest economic hub for Indonesia, and in fact, it is one of the highest contributor of foreign direct investment to Indonesia. So we understand that it's not entirely coming from Singapore originally, but coming from other jurisdictions. But Singapore acting as the hub, and then the investment usually put there and then go contributed to Indonesia. So that's how important Singapore is for Indonesia because of that. And then I would like to touch a little bit about the domestic developments. I know that Pak Ikhwan already covered this, so I will not discuss in a lengthy manner. So in 2021, for your information, so before I'm joining Tax Prime in a tax consulting firm, I was a tax authority senior official. After spending 15 years in the tax authority, then I moved to the private practices. In 2021, I was involved in the making of the harmonization of tax law, which one of the idea is to strengthen the income tax law by adding more anti-avoidance law to the income tax law. So before, we already have transfer pricing, control foreign company, we have the debt tin capitalization, that's the equity ratio. We also have some anti-conduit measures. But after the revision of income tax law in 2021, and then follow up with the government regulation 55/2022, we added more anti-avoidance measures, the general anti-avoidance rules, but not yet effective. I just want to tell you that it is not effective yet. And then the next one is the hybrid mismatch, the hybrid in align with the final report of BEPS Section 2. And then this is a little bit different. This is the benchmarking. Well, I would like to talk about this further, but I will just put here that this is actually an alternative minimum tax inspired regulation. But then after the regulation is stipulated, it transformed to a benchmarking like system. But the GAR and benchmarking are not effective yet because they need more derivative regulations. But as I also presented in December last year in the IFA Indonesia annual seminar, I highlighted that these stipulation of anti-avoidance rules actually has legal intricacies. There is a very big legal question, especially with regard to the GAR. I will not talk about more details about it, but definitely that's it. But because of the derivative regulation are still pending, so it's not stipulated yet. That is why, even though that is very controversial, but because the derivative regulation has not been issued yet, so it's not effective yet. So it's not really being discussed by many people, because also because I understand that the DGT now is also preoccupied with some problems. That's why I think it's very difficult for them to again issue something that is controversial. So I don't know whether international participants are aware of this, but Indonesia just started to implement its new taxation system. I mean the system in terms of like the IT system, which tries to combine everything, all the business processes, and but it seems like the implementation's a little bit troubled, and that's why complaints are everywhere. Even the tax authority has been called to the general parliament session in the Parliament House, and as being questioned, and so that's why it's very controversial. Just before that, just in the end of 2024, there was also controversy with regard to the increase of VAT rate, but the president stepped in and then made a populist policy by explaining that there will be the increase of VAT rate will be cancelled. So but it's still there. So that's why after those controversial matters with regard to taxation, the tax system, and then the VAT rate, that is why I think the tax authority is trying to be very careful on releasing more derivative regulations, especially with this kind of intricacies and legal matters. And that is why I could understand that why they still hold it. But if it actually comes out, well, I think it's a very good topic for discussion, whether a regulation and anti-avoidance measure which legality is questioned could be actually be implemented in the state of law like Indonesia. So I move forward with transfer pricing development. Just another introduction. Indonesia have a robust tax treaty in place. Well, this is not exactly transfer pricing, but just information for international participants. Indonesia has 71 tax treaties in place, and most key jurisdictions are already involved. So that's why if you want to, for example, invest or having business in Indonesia, you will be we will be safeguarded with 71 tax treaties, which are everywhere. Well, problems are here and there, like Arsono already explained. Some interpretations has problems, but basically tax treaties are there, and of course the sanctity of tax treaty should be kept. And then with regard to specifically about transfer pricing, well, different with other international tax issues in Indonesia, transfer pricing actually positively gradually developed. So I can say that transfer pricing regime in Indonesia has gradually increased and improved positively. So because I know that I don't have so much time, so I will just briefly mention the key features of Indonesian transfer pricing regime, and then maybe if there is a follow-up discussion, I will be happy to answer the more specific question. So with regard to the transfer pricing regime, basically what I can say is Indonesia has a transfer pricing regime which basically conforms with the OECD transfer pricing guidances, and even so we have the latest one. The Indonesian government just updated its transfer pricing regulation through the stipulation of Ministry of Finance Regulation 172/2023, which could publicly access in early 2024. So basically that regulations improves some tax and legal certainty, resolves some matter. So it even improves the robustness of Indonesian transfer pricing regulation. So I'm not talking about implementation yet. So I will just talk about the regulation. The regulation is quite solid. So it's pretty much aligned with the OECD transfer pricing guidelines. Now I will go to the key features. So one of the key features that should be well concerned is the price setting approach. So it's commonly called in Indonesia as ex ante approach. So basically the regulation requires taxpayers to assess its transfer price with regard to unprecedented principle. Of course, that's pretty common. But at the stage of price determination, so we know that transfer pricing guidelines actually covering both approaches, the ex ante and ex post approach. But Indonesian regulations specifically ask the taxpayers to set the transfer price in advance by setting the price by referring to the arm's length principle. And it's even being implemented as a formal requirement. So if taxpayer didn't do that, so they could be treated as they don't follow the arm's length principle. So that's why it's very important. And in some transfer pricing audits, it's being the fact that the time when taxpayer actually set the price is often being questioned. And then with regard to the transfer pricing documentation, actually Indonesia is very much aligned with international practices, with the three prong of transfer pricing documentations, the local file, master file, and CBCR. So basically not very different with what the OECD has prescribed. And in the regulation, it prescribes specific elements that have to be there. So what I want to warn for my foreign consultants colleagues is that we have very often got some projects from taxpayers, from our clients, which ask us to translate the transfer pricing documentation. Oh yeah, just for your information, there is actually this is actually obligatory. The transfer pricing documentation is actually prepared in Indonesian language, or if it's prepared in English, the translated version should be provided. So that's why some projects are actually reviewed. But then after we review the transfer pricing documentation, even if it's follow the general common elements of transfer pricing documentations, there are elements that needed to be added. That is why sometimes if we get the translation projects, we have to remind them that, remember that you have an obligation to put this and to put that. You have to explain this and explain that. Otherwise, your transfer pricing documentation, especially local file, will deem to be not complete. So that is why it's important not to only translate your transfer pricing documentation, especially master file, because many taxpayers made only one master file, right? One master file for one group. Well, it's fine, definitely fine, but make sure that you have to follow and comply with the requirement in Indonesia. Every element that is prescribed should be there. So basically that. And then the next one is, well, this is adding much more headache for the taxpayer. The domestic transfer pricing. Well, some jurisdictions don't like this and don't apply this. Some jurisdictions apply consolidated approach, so they don't need to deal with domestic TP. But Indonesia intentionally pursued the domestic transfer pricing, and that has been headache for many years. But actually, the new Minister of Finance Regulation actually comes as a rescue, because even if the domestic TP still being a problem, but the domestic regulation actually make it clear about the corresponding adjustment mechanism. Even if I have to admit that I haven't seen it in action, because we haven't seen derivative regulation with regard to how the corresponding adjustment within the tax authority is being governed. It's still a big question for me, how they will govern this, because of course, well, internally probably there may be some internal competition with regard to tax revenue. I heard that, but principally we haven't seen the internal regulation within the DGT. That's why we don't know how it's governed. And then the interesting thing with the Indonesian domestic regulation is the inclusion of, well, of course, valuation approach is already put as one of the approach that should be taken into account in transfer pricing OECD guidelines. But Indonesian domestic law actually going more explicit by putting valuation as one of the method, in addition to COP, COT, RPM, CPM, TNM, and of course the PSM. So from those key features, I have talked much about the key features. But of course, to be fair, we have also talked and discussed with regard to the challenges. But Indonesia has relatively aggressive transfer pricing audits. The problem is not the regulation. The regulation is gradually improved. But because of not uniform interpretations, Indonesia is a big country, as you know, very big country, many tax offices, so many audits scattered everywhere. Transfer pricing audits is not being handled by one unit, but every local tax unit wherever in Indonesia. That's why it's possible that there are not uniform interpretations. And also the problem is a quite lengthy domestic dispute process. We have objection. It's an administrative appeal to the DTT, and then we have actually court proceeding in a form of appeal, and that's it. But there is an extraordinary additional step, which is the judicial review. But the judicial review usually only focuses on legality matter and not factual matter. So basically, in Indonesia, there is only one effective two sides dispute proceeding, which is the appeal in the tax court. Because the objection, even if it has been improved, I have to say that it has been improved. But at the end of the day, we know the one who handles it is the DTT, which has the same target tax revenue. So the bias, of course, cannot be denied. Because of that, and the robust regulation, but challenging implementation, for us, APA is the most effective solution because it's being handled by single unit by the Directorate International Taxation, which is supported by many foreign educated tax analysts. So it's very nice to talk with them. It's very easy to talk to them because they understand international tax and transfer pricing well. So it's very nice to have an APA and to have the APA process, because the process is not adversarial. So we are not actually vying with them like an audit, but we are elaborating together for a constructive progress. And for the APA, I just want to mention a little about the coverage. So we have the future 5 years coverage, and then possibility of 5 years rollback, and also 5 years extension. So basically, if you're lucky, you will have 15 years protection of APA. But that's something that should be highlighted. And then, as I said, it's taken care by its dedicated unit in the DTT, which has a senior international tax analyst that's pretty well versed with international tax. And then, even if it's not the best right now, but the statistics of APA and MAP in Indonesia is actually increasing. So it's promising. The advanced pricing agreement actually promising, rather than bringing everything to the dispute process. Even if it's also effective, but it's quite lengthy and quite adversarial. I know Melani has already talked about this, but I want to about the global minimum tax. I don't want to talk about that much. Just want to highlight that there is a provision in the global minimum tax Minister of Finance regulation, which fully adopt the OECD documents, model rules, administrative guidance, and everything. That is for Indonesia and a historic development, because we have I personally, my colleague personally, when we were at the DGT, we are trying to encourage. I think it's better to just adopt for example, the Indonesia transfer pricing guidelines. I mean OECD transfer pricing guidelines, except we stipulate something different. It's easier because there are so many things in transfer pricing that hasn't been taken care yet. But at that time, it's still not possible. We don't want to take fully the international guidance into our law, but this global minimum tax provision has shown that Indonesia has progressed and very bravely progressed to fully adopt international guidance into its law. So what I want to highlight is it is important to encourage the government to also do this for other international tax issues, especially transfer pricing, by starting, for example, adopting the transfer pricing guidelines. And then I think that's what I want to present. Thank you, Roustam, for the opportunity. I would be happy to have more discussion.
Okay. Thank you very much. Thank you very much, Bobby. Very informative, very interesting. And you mentioned several, let's say, guidances by the tax administration. May I ask you to share them? And also, Ivan mentioned that there was a guidance on tax treaty interpretation. Please do share with modern technologies. It's very easy to translate into any language. And it will be very, very useful for other tax administrations to learn from Indonesian experience, not necessarily copy and follow every single letter in it, but it's just useful to know what other tax agencies are doing.
Sure. We'll be very happy. We'll be very happy to share. Even if it's not the law, it's just a reference, but it basically actually incorporates the OECD model convention commentary into the internal tax authority use. But it's
please go
it
ahead.
shows the precedence.
Sorry.
So that's basically it.
Okay, good. Small sound delay, and sometimes we just speak simultaneously. So sorry for this.
Sorry.
Please go ahead and finalize your thoughts, or I will just keep silent till you find.
No, fine.
Okay.
So with regard to the guidances, I would be very happy to share. But with regard to tax treaty, actually the DTT has its internal guidance, but it basically adopts the OECD model commentary. Well, I'm not really interested in the wording because it's basically coming from the commentary. What interesting for me is the willingness to adopt the commentary, which is very important. Well, as you know, the commentary is very, very resourceful for tax treaty cases. And as Pa Arsono said, with regard to beneficial ownership, we are trying to encourage the use of this international guidance for better and consistent implementation of tax treaties everywhere.
Not willing to trigger like the whole new discussion, but sometimes I hear concern because you mentioned to the reference to OECD commentary. In the recent clarifications of Indian tax authorities on principal purpose test, they clearly referred not only to OECD but also to UN model and clarifications. And this comes from the view that countries like Indonesia, India, they do not always feel that they have enough, let's say, power, impact, and influence on what is happening within OECD. So that's why when I personally support the approach that when everyone plays according to the same rules, at least this is predictable. At the same time, some authorities, they ask questions why we should be playing by rules on which we do not have any influence. Why don't we do something our own? So there is always a discussion, and interesting to see how it realizes in practice. And Ivan also mentioned qualification by tax authorities, so it would be also good to have.
I agree, actually, Roustam, that's in transfer pricing we have APA, but in other matters we don't have anything. In Indonesia, we don't have anything to rely with regard to interpretation and clarification, and that is why I agree. That is why I really appreciate when they issued a guidance for their officers to actually take into account, for example, like the OECD commentary. Why? Because I know that there is a political discussion with regard to do we really have voices in these regulations, but the problem is without the commentary, for example, taxpayers are left in the dark. And then due to the aggressive transfer pricing audit, for example, or the international tax audit, that would, as Sono already explained, there will be problems, especially because we only have, as I said, one layer effective appeal. That's problematic. That is why clarification and tax ruling is really needed in Indonesia. And we from Indonesia, of course, always encourage that to be applied in Indonesia.
Okay, excellent. Well, thank you very much. Thank you very much, Bobby. If there are any quick questions, please feel free to share them. If there are no, we can just move forward. And I would like to thank you, Bobby, and also Mr. T. Arsono, sorry, for your contributions. You are most welcome to stay and continue and intervene into the discussion. If you need to leave for whatever reason, feel free to do so. And well, yeah.
Thank you very much, Roustam, and everybody. Thank you. I really appreciate the opportunity.
Okay.
Bye.
Thank you. Bye. Now we can move further, and I'm very much indebted to another remarkable and distinguished ITC alumni, Mr. Yimin Ku, our Chinese colleague, who already joined some of the initiatives of ITC Leiden and delivered excellent lecture on Chinese international tax developments in the series of lectures which we were recording almost 4 years ago. Actually, time flies so fast. It was 2021 when we did some, let's say, summer school of ITC Leiden, and it was very impressive and very in-depth lecture. And this time we asked Yimin to share experience of application of general anti-avoidance rule in China. Yimin is a partner at litigation firm, Jingsh law firm. I'm not speaking Chinese, unfortunately, so forgive me wrong pronunciation, but very reputable person. I'm very happy that you had found opportunity to join us and share your expertise in such important topic as general anti-avoidance rule. Do you need any assistance with presentations, or will you open the slides, or you would like me to help with this?
I'll share from my side.
Okay.
So, no, yes. Yeah. It's clear?
Yes.
Okay. This one.
You can unfold this presentation as well to make it fully open. Yeah, close to this. Yes, this one.
Yeah. It's very happy to be reunited together again. So my topic today is related to Chinese GAAP policy. But you know, after I prepared the content, I found that we might use a one key term to describe the content today. That is interaction. So what is so let me explain why the key interaction is very important in this lecture. And interrelation between, you know, domestic law and treaty, interaction between, you know, the current Chinese GAAP and the, you know, the MLI, you know, tax, you know, PPT, and interaction between, you know, evidence and, you know, legal act, and interaction between, you know, legal form and substance, economic substance. So all is related to interaction. So I you know, I invite all of you to pay attention to the interaction. You know, for my, you know, for my lecture. Yeah. So let's start. This is a outline for this lecture. And firstly, I will analyze MLI in force in China from, you know, 2022. So yeah. Is clear? Okay, let's stay here. Okay, and so that's the first part. I will use now a few minutes to explain, and then we'll briefly introduction of international tax litigation in practice in China and our tax dispute resolution in China, and then we'll go to the GAR in China because if we don't understand the tax dispute resolution in China, we'll to hardly understand the impact the tax dispute regarding GAR in China, and then I will use one case to illustrate the tax opinion about GAR and their attitude, and finally we'll go to the alternative remedy approaches for the cases we'll discuss. So that's the outline. So we'll go. Yeah. So the first section regarding to the MLI and the legal effect in China and the Singapore tax treaty. China has adopted the following two MLI articles that reflect the minimum standards of BEPS Action 6. And both are adopted by China and Singapore. So it is very important to notice that changes. So let me explain one by one. The Article 6, a purpose of covered tax agreement, adding two elements. That's one is desiring to further development their economic relationship and to enhance their cooperation in tax matters. And the second is without creating opportunities for non-taxation or reduced taxation through evasion or avoidance. So for the first, purpose and so desiring to further develop their economic relationship and enhance their cooperation in tax matters, it's very important for the PPT, interruption later, because while the treaty signed by two countries, they have some, intention about the treaty's purpose. If the treaty's purpose is focused on develop their economic relationship, maybe that these addings will help a lot to the future cases regarding to GAR cases. So I invite you to pay attention to these addings. So as for the Article 7 of prevention of treaty abuse, that reflecting the Action 6 minimum standards of choosing the PPT, that principal purpose test, adopting, by adopting by China and Singapore in the following, in the following paragraph, article that is paragraph 1 of Article 7, paragraph 1 of Article 10, paragraph 8 of Article 11, and paragraph 7 of Article 12 in China and Singapore tax treaties. So let's pay more attention to the new adding, which is a PPT test. So I will briefly reading the paragraph and then analyze this paragraph. So if the benefit and the covered tax agreement shall not be granted in respect of an item income or capital, if it is reasonable to conclude, having regard to all relevant facts and circumstances, and that obtain that benefit was one of the principal purpose of any arrangement or transaction that result directly or indirectly in that benefit, unless it is established that granting that benefit in this circumstance will be in accordance with the object and purpose of the relevant provisions of the covered tax agreement. So, this paragraph is very important to understand the PPT in China and Singapore tax treaty, and to conduct PPT test, we need to analyze the very beginning from the evidence. So they after carefully analyze evidence, we could get the all relevant facts and circumstance, and after that we need to reasonably analyze. What is reasonable analyze? Sometimes people think the reasonable means from the subjective, but at this paragraph, the reasonable must be interpreted from the objective purpose. So why? Because while we carefully analyze the relevant facts and circumstances, we could get a conclusion about the whether it is a legal act or whether it's economical substance relating the economic. So from that point, all these analysis is related to objective analysis. So after we get the result of the objective analysis, then we'll go to the principal purpose test. That means we'll go to the subjective analysis, because the purpose is intention from the parties. So we'll go from the objective analysis to the subject analysis. So that's the order of this paragraph's logic. So do not to neglect any steps. And so from these two aspects, we can get the conclusion that is the tax authorities have the obligation to analyze all relevant facts and circumstances, and then all these facts and circumstances have to be or must be waived, and then the tax authorities have to analyze in an objective analysis. That is a tax authority's obligation. If the tax authority have or briefly analyze, or if the tax authority jump the step, then that means the tax authority's obligation does not fulfill. So if the tax authority does not fulfill its obligation, if it's very important, and then they will leading to the failure of the case. So that is very important. I'll go to another slide to illustrate this logic or this process. It will help you to understand the process. So and for the cases at hand, we will have a lot of evidence. So to analyze the facts and circumstances. So the very beginning start is the evidence. So firstly, we need to analyze evidence and decide know what is a very related evidence. So from the related evidence, we can get the facts and circumstances, and based on these facts and circumstances, we can apply law and get the result of the legal act. And since this is the GAR, anti-avoidance rules, and so we in China we apply a substance over form principle on the legal forms. So after we apply substance over form principles, we can get economic substance, or so from the economic point of view. So that's the way. Then we go to all these three types have to be analyzed in the objective way. So so that's the first three steps, which in line with what we just not analyze in the PPT just now. And let's continue to finish this slide. So after we got economic substance, so we from this economic substance, we can deduce from objective test to subjective test to get the purpose. And at this point, we might get some purpose. Not only sometimes or most of the times it's not only a purpose of these economic substances. So we get maybe 3 or maybe more purpose. We after the purpose is compare or to be specified, after these purpose to be waived, and then we can end the just we can that means we have to justly consider each purpose. We cannot just neglect the purpose, and so we need to justly consider each purpose and compare, and then go to the result of whether or not there is a reasonable business purpose or not. So that is the process of argumentation of apply GAR. And also, I believe also when we apply the PPT. So this logic and cannot be jumped. To be I also want to mention another the point is that this logic or this process of argumentation is just not only one way. It's sometimes the case is very important, complex. We need to go and go and back and go and back and again and again, and then we can get the result. So don't misunderstanding. This is just not one way. Sometimes we need to go back to the legal act. That means step 2. Sometimes we need to go back to economic substance. That is step 3. Or sometimes we might need to go back to the very beginning, the evidence. So that's this slide. I think we need to go very fast, very quick. And then so as for this PPT paragraph, don't forget the exceptions. That is unless it is established that granting that benefit in these circumstances will be in accordance with the object and purpose. So there is an exception of the PPT. Don't forget that. So so to summarize, China and Singapore both adopt the Article 6 and Article 7. So while there is a GAR cases in China or in Singapore, we have to consider these PPT test, which means we have to or to go to the very beginning analysis assessment, that is, all relevant facts and circumstances. And then we go to the principal purpose test, and don't forget the exception. So that's the China and Singapore update. So what tax treaty update? So that there comes a question which is very complicated. So that means when Chinese domestic GAR meeting MLI PPT, does PPT limit China have to adopting the second test? That means the exception. So for it's not clear yet, because the time. But the starting analysis on this discussion in China in beginning. So the result. But unfortunately, the result isn't clear yet. Just as I said, it's very complicated to analyze. So let's go to another next step section, which relate to international tax litigation. And in China, actually, international tax litigation case is very few and less than 10 cases. And most important cases is the case in red, meaning the children's investment master fund case. This case was, in the Supreme Court for final judgment. So, and we'll go to this case for this further discussion. And I want to share you about the tax dispute resolution in China. And in practice, tax dispute in China mainly be settled at the administrative examination stage or the administrative reconsideration procedure. And so it is not very common for taxpayer to take the authority to court. But recent years we have seen the tax dispute, growing. And as for the GAR cases, since the children's investment master fund case at the Supreme Court failed, so taxpayer more prefer to not select going to litigation. And we have to say that compared with Canada, India, and US, Chinese international tax administration litigation system is still in the development. So sometimes it's very often just difficult for the court to examine the tax authorities' action. And that's this section. So, and then we'll go quick to Chinese GAR provisions, and we have the GAR provisions in China, and from law, from regulation, and from the circular decree and notice. So it's the third line, all issued by the SAT. And let's go to the GAR in China. So when we mention the GAR in China, the GAR, we mean the GAR in China refers not only to laws and regulation, but also to the official interpretation as published by the SAT. And so let's quick to analyze the GAR in China in the law, which is Article 10 in our enterprise income tax law, meaning where enterprise input other other arrangement without reasonable business purpose to reduce payable income income, the tax authority has the right to make adjustment with a reasonable method. So in this article in law, we raised the reasonable business purpose criteria for tax authorities to give the assessment. So Article 122 of regulation also try to interpret what is the without any reasonable commercial purpose. So this will go quick. And and as mentioned that the circulars, all from the SAT to try to illustrate what is the reasonable business purpose. And from the circulars from SAT, actually, by interpreting, they add some, other criteria apart from the reasonable purpose, such as substance or form test, such as, economic substance test. So, so that's very practical in China because where our tax law system and is not in a development of fulfill. So so that means the tax authority, the SAT have the lot of obligation to illustrate in detail. So this one is about in China we have the purpose, reasonable business purpose test. We have the substance or form test. We have the economic substance test. But from my point of view, the principle of substance or form is a kind of analyzer. So from to the facts and substance. While the form is not in line with the substance, so it's not a criteria. So to summarize, in China we have the reasonable business purpose and economic substance test for the gas. So that procedure, this procedure, I already analyzed it before. This is very important, for the audience to understand. This is summarized by our team. So we use this, process to, to avoid the logical jump. And sometimes, the court or the tax authorities, get the conclusion, often not follow this, for process argumentation. That means sometimes make a logical judgment mistake. So I'll very quick go to the case, and then we will go to the last part. And this case related to a indirect, actually transfer. And so this case is only a GAR cases in Chinese court, and in the for the review of the Supreme Court, it's very important. And so I'll quickly go this slide. And the argument and judgment, I'll to go very quickly. And from this case, since the tax authority as a defendant, raised there's no reasonable commercial purpose for the TCI, that's the plaintiff, and they raised the three factors. That factor, all related to, to the such as the intermediate company registered in tax haven, and they don't have the substance economic substance, and all the equity transfer price mainly depends on the value of the Chinese resident enterprise, and the equity transferee disclose the actual subject target of the acquisition was the equity of the Chinese company. Based on this fact, tax authority determine this indirect equity transfer without a reasonable commercial purpose, but they didn't, show the detailed process of logical analysis, which we just show earlier, and we'll neglect to see TCS as plaintiff opinion, so it's not very relevant. So from a Chinese court's point of view, the first instance court said that there's no just accept the tax authority's opinion, and without a very detailed explanation, and to get the conclusion of the case without a reasonable commercial purpose. And the second cause, and get the conclusion, meaning there is no economic substance, but both cause does not pay attention to the details of the process of argument deducement. So okay. Yeah. So for the Supreme Court, and they add the evidence factor. They hold the opinion that the evidence provided by tax authority in the original trial is stronger, and but in the Supreme Court doesn't show how these evidence pay more get the conclusion of stronger than TCS. So we didn't see the reasoning. So that go back to the process I just mentioned before. We need to very carefully to analyze evidence, in the case, to get the facts and circumstance, and to get the legal fact, and then get to the economical, substance. So all these, steps cannot be avoided or cannot be jumped. These are actually is the liability of the tax authorities. Well, they fulfill to prove they get the detailed analysis, meaning analysis from the objective analysis. And I believe that according to Chinese law, they will fill the case. But this case, we didn't see the detailed analysis from tax authority. So, and for the alternative remedy approach, I will give up to share because it's our time is very limited, and so I think this point just to this one to add another point of this case, and also we need to combine to analysis from the point of PPT. So actually in China we have the theory of justifiable defense, and or we call it eliminating misfeasance, right? So if this case focus more attention on this factor, and I believe they will get the different conclusion. So do not to forget about the theory of eliminating misfeasance. Actually, this is similar to PPT second test. Remember, that's the second option. That's the exception of that paragraph, meaning unless it is established that granting that benefit in this circumstance would be in line with the object and purpose. So this is very important for the case for the tax case litigation. Yeah, we already analyze. So to summarize that, while we analyze the GAR case and also from a China-Singapore tax treaty point of view, we have to go reasonable commercial purpose test and economic substance test in China. And before we draw a conclusion of anti-avoidance, we need to pay a lot of attention to the objective analysis to weigh all possible possibility of purpose. And then we check whether there is a possibility of eliminating misfeasance and whether in line with MLPPT to test or not. And then we'll go to the final conclusion. So that's a very important logical process. So that comes with my end of my part. I'll go back to the Roustam. Thank you.
Okay, thank you very much. Thank you. Specifically, very useful to hear the experts from the jurisdiction, because there are not that much information available on China, in particular on Chinese jurisprudence. Well, first of all, because of not so many people can read Chinese, and I personally have no idea how to Google, for example, the collection of China court cases. So it's very valuable to listen what is happening in this very important jurisdiction. And Yimin, may I ask you please to share the texts of this judgment, because with modern technologies, it is not that difficult to translate them into English language, into other languages. And well, please keep us updated
Okay.
on the development. Okay. Would be any questions to Yimin? We're slightly behind the schedule, but it is manageable, so we can take 1 or 2 questions. If there would be any from our audience. Our Indonesian colleagues had to leave, and I really admire your and Marcio's patience and dedication, because it's already 20 past 6 p.m. on Friday in China and in Hong Kong, and you are still with us. So very much appreciated. I do not see any questions, and I would like to thank you. I would like to ask you to share your presentation, because the recording of this session will be placed to well, specific LMS to make it accessible to those colleagues who couldn't attend this live session. So materials are most welcome. Thank you once more. Then thank you once more. I mean, you are most welcome to stay if you would like to comment or participate. And we're waiting for joining David Barinsky. He is going to give very interesting comments on recent U.S. administration tax steps, initiatives, and it has particular impact on China. So that's one of the anticipated presentations. Marcio, my apologies for being a bit late with your presentation. So what Yimin was delivering was so excited, so I just couldn't really resist and wanted to hear the ending of this story. The next speaker is Marcio Morgante. Not typical Chinese or Hong Kong name. So Marcio is of Italian origin, but he stays in Hong Kong for many, many years. We also met in Berlin at IFA Congress a couple of years ago. Marcio is managing director of Asian Tax Advisory. And I asked Marcio to update us on Hong Kong international tax developments. So it would be very useful to learn what is happening in this important through-bound jurisdictions of the region.
Thank you, Roustam. Thank you very much for your introduction. I'm not sure if you can see my screen. I mean,
we can. I see the first slide outline Hong Kong.
The outline. Okay. So it's yes. So we'll start from a general outline, basically the presentation of on the updates on the international taxation here in Hong Kong. First, a general introduction to the Hong Kong tax regime and its tax treaty network, and the banking sector, considering also the movement of capital. So basically, why to choose Hong Kong as a holding jurisdiction, which is Hong Kong is the primary holding jurisdiction. And it's one of the primary hub in Asia, together with Singapore, to access for Asia. So we will analyze what are the main reasons to choose Hong Kong over Singapore or over a jurisdiction when you're thinking about doing business in Asia. Then, recently, under pressure from the European Union, the Hong Kong introduced the foreign source income exemption. Basically, now all the capital gains, as we'll see, passive income are taxable in Hong Kong, cross-border, but there are some exemptions to it, which we will analyze yet later. Then a brief overlook about the implementation of Pillar 2, which is also coming in effect in Hong Kong. Another hot topic in Hong Kong is the recent removal of a special stamp duty on real estate, which to facilitate and boost the local real estate market, which in the past year, let's say after COVID, it took quite a hit, and therefore, the Hong Kong government is trying to boost again this sector, which is a very important sector in Hong Kong, even more important than the financial sector. A recent reform is about the redistribution regime of companies. So basically, company moving in Hong Kong. So this is becoming possible. So in order to attract foreign company to redomicile in Hong Kong under this new regime, and then to end with offshore regime application, which is always very interesting. It's basically a territorial principle of taxation in Hong Kong. Just a brief overview how it works, and new schemes which have been introduced in order to attract family-owned investor vehicles. So basically, family offices, in order to exempt from taxation or minimize taxation for family office, single family office in investing in Hong Kong. Okay. So this is the why to choose Hong Kong as a holding jurisdiction. Like we said before, Hong Kong is a primary holding jurisdiction in Asia, with a broad tax treaty network. Up to date, there are 51 tax treaty signed in place in force so far. There is limited taxation and on passive income, so capital gain, dividends, interest, and royalties in Hong Kong. So which is, as we know, is very important for holding companies. In general, the tax rate, also considering nowadays the Pillar 2, so the global taxation, global minimum tax, is 16.5, so it's above the minimum threshold, let's say, of 15%. There are no VAT regulations, meaning that makes things easier for to operate in Hong Kong. There has been some push in order to introduce in Hong Kong some VAT regulation because of a budget deficit, which right now Hong Kong is incurring to. But let's say so far that there are no news about that to introduce a VAT in Hong Kong. So for the foreseeable future, at least, it's planned to stay the same. And of course, like an efficient banking sector, which is very important. So with a multi-currency and the possibility to make payments, freely payments from in and out to Hong Kong, and no limitation on currency exchanges. And of course, a very good access to different financial product and lending rates. So again, which is ideal if you want to attract holding companies, specifically family office and investment funds. In relation, whenever into equity or loan, which is a classic question when you need to make an investment, there are no limitations. So the funds can be injected through share capital or loan. It does not matter that there is no ratio for it. And yes, and of course, but so the country of residence, especially when you're talking to banks here in Hong Kong, it is very important, especially part of passport holder, which might make things difficult to, let's say, to deal with banks, depending on the beneficial owners of a corporate in question. Okay, let's go to the next slide. Okay, like we said before, this is a recently introduced a couple of years ago foreign source income exemption regime under pressure of especially from the European Union. So basically now for multinational groups, the cross-border, so passive income, so dividends, interest, and royalties and capital gain are subject to tax unless exemption, one of the exemption applies. Which are the exemption? In brief, it is requested for the company in Hong Kong to prove to go through the economic substance exemption test, which depending if it's a pure equity holding company, so basically if it's a pure holding company, there is a reduced substantial activity test. So therefore, maybe the director has to be resident in Hong Kong, or the holding company needs to have an office in Hong Kong, and the activities conducted could all include the holding company and managing its equity participation and comply with a corporate law filing requirements in Hong Kong. Instead, for non-pure holding company, equity holding company, which means can be like a trading company or so on, so it means active company, there is a higher economic substance requirement that would basically require a number of employees, an adequate number of employees, and also according to their qualification, and an adequate amount of operating expenditure in Hong Kong for carrying out the activities of a company. In this case, it depending, of course, by the scope of a company. If it's a trading company, it needs to have an office, employees, and it doesn't count usually nominee director, but the majority of a board of directors has to be people resident in Hong Kong in order to pass this economic substance exemption. In any case, there is no minimum threshold required and there is a totality of facts, of a fact approach, so substance approach by the Inland Revenue Department of Hong Kong, which in order to evaluate whether there is enough substance to pass this test. The second criteria is the participation exemption for dividend, disposal gains, so capital gain from non-IP assets. And in this case, basically, for the participation exemption, the participation has to be held for no less than 1 year immediately after the disposal, before the disposal of a capital gain of gain accrued, and not less than 5% of equity interest in the invested company. There are some anti-abuse rules in relation to the participation exemption, specifically that the subsidiary, for example, in the foreign state has to be subject to tax, but that's something that you need to consider in order to pass this test. Instead, for the royalties, so for the IP income, disposal of gain related to IP assets, there is a nexus exemption, briefly referring to only the portion of income derived from qualified intellectual properties and would be exempted. And it's calculated making reference to the research and development expenditure incurred. So basically, if a IP holding company is incurring some research and development expenses in Hong Kong, that portion of income, then you need to make a computation that the convention is exempted from taxation in Hong Kong. There are also some, for the disposal of gains from intergroup transfer, there are some tax relief, which also the company may enjoy and benefit the group. One important principle consider what I mentioned above, is that the foreign source income, so the income derived from abroad, is only subject to tax in Hong Kong if the exemption do not apply. If a payment, the receipt is received in Hong Kong. So if there is a remittance in Hong Kong, in a Hong Kong bank, then the income is subject to tax. If that income is not remitted in Hong Kong, then it is not subject to tax, even if exemptions mentioned above do not apply. Let's move quickly to the Pillar 2. Hong Kong is also, like, starting from this year, is going to implement, according to the BEPS 2 framework, the Hong Kong minimum top-up tax from this year onwards, and which operates consistently with global rules. Basically, like, a constituent of entities in scope with a multinational group located operating in Hong Kong, which also is applied in priority over the income inclusion rules and the under tax payment rule. Investment entity and insurance investment entity are excluded from the scope of the Hong Kong minimum top-up tax, so as to preserve their neutrality. And basically, the Hong Kong minimum top-up tax is designed to meet the requirement of the qualified domestic minimum top-up tax as provided by the global rules. And it is credible and it is creditable against the top-up tax as imposed under the global rules, so which is a very important to obtain in this case the tax release. There are some safe harbor would be available if certain conditions are met. The top-up tax in Hong Kong rules are deemed as profit tax. So basically, it's also this facilitate according to the tax treaties applicable to assimilate to the profit tax, which is in Hong Kong is the corporate income tax. Also recently, the Indian Revenue Department came out with some tax compliance and administration. So basically, came out with some for the tax burden and related administrative burden to require to furnish a single top-up tax return. So the company will have to file a tax return for the Hong Kong top-up tax, basically, and it is required to do an annual filing, a notification related to its obligation or filing for the top-up tax return. And it is very similar in any case, the top-up tax return to the normal profit tax return. Besides that, it doesn't charge any provisional top-up tax. And then there is all the rest of the timeline, which is 2 months after the date of a notice of a year of assessment. This also we have to how we further develop with news coming from Pillar 2 at the global level, but then we will leave it to the US part to discuss about that. Another important to boost the economy, especially the real estate market, the Hong Kong government recently removed the 30% special stamp duty taxation on real estate transaction, and this to boost the local market, the local real estate market. And as you can see from the table, which is the table is in Hong Kong dollar, so it's not US dollar, which would be a crazy amount. So it's but still like it reduced significantly. So from 30% now the stamp duty tax on the real estate transaction, it was lowered to a maximum cap of, as you can see, above 21 million of real estate value to 25%. Again, in order to boost the real estate market in Hong Kong. This is one of the recent, just came out, the company redomiciliation regime. In order to attract foreign company to redomicile in Hong Kong, foreign company incorporated abroad to transfer the domicile to Hong Kong. So this is now possible. That the law is being implemented. But there are still, from a tax perspective, there are still a lot of questions of how this will play out from because there are similar regimes which you have seen like in Europe. Of course, like as you know, in Europe it is possible for a company to domicile according to the freedom of movement, freedom of capital flow, to redomicile from one country to the other. In Hong Kong, it was not yet possible, so this is becoming possible, but we are still waiting for the implementation of how this will play out, besides that from a corporate law perspective, how this will become possible from a tax perspective, especially for the losses carry forward, for the deduction of a cost incurred previously. So the IRD now is considered when we'll consider to issue some guidelines, and also how this will play out under the current tax treaty network, because Hong Kong, as a peculiarity which did not list of as a definition of for tax purposes of resident for companies resident in Hong Kong, and therefore under Article 4 of relevant tax treaties, Hong Kong always defined like companies had to define the companies, what a resident company means under Hong Kong law, which was like a company incorporated in Hong Kong. So now the IRD is planning to consider also for tax treaty purposes this redomicile company which have not been incorporated in Hong Kong according to the wording of the tax treaties, but also, of course, they will be regarded as a company incorporated in Hong Kong, and therefore they will be able, these companies, to benefit from the tax treaty network for Hong Kong. Otherwise, it will be, as you can imagine, a big problem for this company if it cannot enjoy the benefit from the tax treaty network for Hong Kong. Very quickly on the offshore regime application, which has been in place since Hong Kong has always been taxed on a territorial principle, on a territorial basis principle, has always been in place for a number of years. And I must say it's a very successful, proved during the years to be a very successful regime, and to attract new investments, especially as a holding jurisdiction, not only, of course, for holding company, but especially in this case, as you can imagine, for trading companies or service companies, so on. Also because it's not an exemption regime, but it's a pure territorial system, meaning that Hong Kong tax only income derived in Hong Kong. Income which is derived instead outside of Hong Kong is not subject to tax, but it's not even requested, for example, like in Singapore, income which is derived outside of Singapore, if it's exempted, but still if it has to be subject to tax by permanent establishment abroad of other means in order to be exempted in Singapore. Instead, in Hong Kong, this requirement is not a must, so which makes things easier, let's say. But of course, the Inland Revenue Department of Hong Kong require then they will issue a letter to the taxpayer, and the taxpayer will have to lodge like offshore claim application, and will offshore claim during profit tax return, and therefore we have to prove after the IRD has issued a letter to prove that the taxpayer carry out all the activity outside of Hong Kong with relevant supporting documentation, which will have to be reviewed by the Inland Revenue Department. Which means like usually like means like the Inland Revenue Department will go through the activities, the agreements which have been signed, where they've been negotiated, list of the employees and roles where these employees are located. These are some of the items which you may go through with the Inland Revenue Department. Customer and supply list, especially the customer. If the customer are from Hong Kong, then this usually we have seen in practice that this may be an issue for the Inland Revenue Department to grant the offshore application to the offshore claim. Sorry. They will go through the traveling schedule of a director and the key personnel to determine where the negotiation has been carried out. And in this case, also the emails they will analyze. They may ask also requests for emails in order to prove that the negotiation in relation to the execution of agreement or the execution of agreement for signing have been done outside of Hong Kong. So it may be quite troublesome. There may be a lot of documentation. There is a lot of work in some we have seen in practice. We have seen in order to successfully carry out this offshore application with the Inland Revenue Department. Something similar, which of course can be carried out also according to the offshore application, so for a general company, but this is more specific, let's say, so you can say it's under the umbrella or follows the same principle of offshore claim application, but this has been targeted, there's been a specific regulation targeting family offices and about profit tax concession. So for eligible family-owned investment holding vehicles managed by single family office, so it means there's just one family, so it cannot be like multiple family, because then it would be different, it would be a sort of like private equity.
Marcio, my apologies for interrupting. We have already David Barinsky in the room, who woke up at 6:30 in the morning to get this discussion.
Pardon me, 5:30.
Yeah, in the next couple of minutes, if you need more time.
Yeah, almost done. 1 minute, couple of minutes, 1 minute, then done.
Excellent, thank you.
Okay, yeah. So the assessable profits for this family office will be arising from this qualifying transaction. Since the transaction will be zero, so it will make things in order again attractive. And has been this regime, this particular regime, has been in place since 2022. There are some minimum requirements like structure, ownership, and management control of this family office, and of course there is a minimum asset threshold to apply these benefits. So I was about to finish. The one last point, which I didn't put into the slide, may be worth. Also, Hong Kong is planning to introduce a digital service tax, like Kees was mentioning at the beginning. So we'll see. They are discussing about it, which maybe later will maybe even be converted to VAT. We'll see. But so Hong Kong is planning to do this digital service tax, which will not be under the umbrella. It seems since Pillar 1 is not, if it's not happening, then like Hong Kong, like many other jurisdictions, will implement this tax, or it's planning to implement this tax. But we are yet to see how we will end up, because we are not. But yeah, this is the one, just a rumor, let's say, and then but yet to see. Okay, that's it, Roustam, I'm done. Yeah.
Thank you very much, Marcio. I would like to ask your permission to get your presentation and store it with other materials of this conference. so
Sure.
made accessible to people who couldn't participate in the live discussion because of whatever reason. One of them might be simply timing, because I also very much appreciate your dedication. So you are staying live on Friday evening at almost 7 p.m. local time. Meanwhile, what I like about communication between Leiden alumni, besides staying in a community where the sun never sets down, so it's 8 p.m. in your location zone, at almost 6 a.m. In location of our next speaker, David Barinsky. Meanwhile, I received the file from Ivan Sukardi. This is the translation of clarifications of Indonesian tax authorities on application of tax treaties. We also will share this with attendees of this event in a specific section of a recording of this conference. And I would like to draw attention of our attendees to training which Kees is going to perform in Singapore, which is very much welcome for attendance. That's, I believe, the program I wanted to show you once more. So feel free to access through QR code. Consider participating in this training. Meanwhile, we are moving further. So Marcio, thank you once more for your excellent presentation.
Thank you, Roustam.
Our next speaker is David Barinsky, my long-term friend and excellent speaker on US international tax and policy. David is International Tax Counsel at Premium Law Group and US international and domestic tax expert. And we had very interesting conversation with David recently. When I do not understand something about US tax policy, I come to David and ask him to clarify. So what is going on? And what we saw is the kind of sporadic actions, steps taken by US tax administration seem to be a part of the process, which has certain aims and may have certain consequences and impact on international tax planning in Southeast Asian region. And in this respect, I wanted to ask David several questions. If and when David would be ready.
Yes, I'm ready. Pardon me.
Okay, good. Well, David, the first question. What is the current US international tax policy trends, in particular Trump decrease on OECD, on tariffs, and which impact it is going to have on the Singapore and Southeast Asia in general?
Well, thank you for having me and thank you for the question. First of all, it's 5:30, so I want to correct that statement on your part, not 6:30. And hopefully that will make me a better person. You read for health purposes to get up early. So thank you, Roustam, for making me a better person, at least today until I go back to sleep after this lecture. The two main areas worth commenting on in this context would be the interface of U.S. international income tax rules and Pillar 2. The heart of the U.S. international tax rules, a good part of the heart was the 2017 Tax Act, which before we had Pillar 2 brought the U.S. closer to the concept of Pillar 2 of a minimum tax. That's the good news. The frustrating thing is there's not a strong urge, either politically or from a policymaking standpoint, to align with Pillar 2. So that it's worth mentioning here the mismatches between U.S. tax law and Pillar 2, because that's going to be an intellectual challenge, which will be worked out for the most part, I'm sure, by competent tax attorneys in the relevant countries. The idea of the U.S. rules, of the so-called GILTI, GILTI rules, and other controlled foreign corporation rules, is to impose a minimum tax on U.S. corporations for their overseas operations. The problem, in the sense of it not matching Pillar 2, are as follows. Pillar 2 requires country-by-country reporting. So if you don't meet the minimum tax threshold in country A, the fact that you're 5 points low, if you're 5 points ahead in country B, you still are subject to the Pillar 2 minimum tax rules. The U.S. rules in that respect allow you to blend, so you have one net tax rate for your non-U.S. income. So that's one mismatch. The second thing is that the rate under the CFC, well, particularly the I'll just say GILTI rules. The GILTI rules are lower than the Pillar 2 threshold. So you're always going to be at risk of a top-up tax or other remedy on the part of a Pillar 2 compliant country. The third thing is that the U.S. controlled foreign corporation rules, including the GILTI rules are part of the controlled foreign corporation rules, has stock ownership tests that are completely different from the Pillar 2 test. It has to do with whether you're a significant shareholder and so forth. And as everyone on this call likely knows, under Pillar 2, there are no threshold ownership inquiries. There is a threshold revenue inquiry of it being over 750 million. It's 530. I can't remember if it's 750 million euros or $750 million, but be that as it may, there's no threshold under which you can avoid the U.S. GILTI tax. And then the two more things: the foreign tax credits are complicated for GILTI taxes you pay overseas, so there's bound to be some mismatches there. And last but not least, because the compliance burdens for U.S. corporations that would be subject to the Pillar Tax 2 rules are considerable. They're considerable for companies in other countries as well. That's just going to be a constant source of friction. So it's sort of tolerably close, but when you really have to pay for it and figure out how to undo unintended consequences, many would say it's not tolerable. In any event, that's as far as we can go with the income tax issues, because the atmosphere in the U.S. right now is very politicized, and there are other causes, missions, passions that motivate both people in the Trump administration and their political opponents in the Democratic Party. And insofar as they're, as we say, above the fold on a newspaper, the articles that are above the fold when people used to read paper newspapers, is more in the area of tariffs. So there's just not going to be a lot of energy expended by anyone, either on the Trump side or Trump's opponents, to quote unquote fix the mismatch with Pillar 2. The big item are tariffs. And this is just me pretending to be an expert. It is before 6 o'clock here, so you'll have to indulge me for either incoherence or grandiosity, perhaps a bit of both. I think that there's the supply chain for so many manufacturers it runs through Southeast Asia and China. There's a migration. I know for a fact that I have clients that I'm advising who are moving operations from China to countries such as Thailand and Indonesia and Vietnam. So in that sense, Singapore obviously becomes more important because it's a hub for activities of this kind in the non-Chinese, non-mainland Chinese, Southeast Asian manufacturing countries. So tariffs, so there's a in a sense positive effect of the migration from China on the part of Indonesia, Thailand, Vietnam, and other similarly situated countries. But the tariffs are going to upset those area economies, meaning that insofar as Singapore banks are have a large amount of money at risk in firms in those countries, it's possible it will have a negative effect on financial institutions in Singapore. On the other hand, the U.S. and Singapore have a free trade agreement. There's no tariffs, so that all this saber rattling and threats and perhaps implementation of reciprocal tariffs on the part of the U.S. will not disrupt actual trade between Singapore and the U.S. And what's interesting is that if you just test under the various customs law rules, you know, whether something qualifies as a Singapore good, Singapore item that's being imported into the U.S., it's possible and likely that many manufacturers will be able to route some of their functions, production functions, through Singapore, and therefore thereby qualify for the U.S.-Singapore Free Trade Agreement zero tariff arrangement. So there's the possible damage to financial institutions on the one hand. There's the incentive to route part of the supply chain functions through Singapore to take advantage of the U.S.-Singapore Free Trade Agreement. So I think on the whole, the problems with China are the most pertinent factors to consider in terms of the effective trends in general on Singapore. I think, as not an expert certainly on Singapore financial institutions, it's my guess would be that it would be beneficial to Singapore. Of course, there's the obvious point that the Chinese government pushing its thumb down on increasingly by the months and years on Hong Kong means that obviously Singapore, which has a very high reputation in that area, is going to be the benefit of that. So that's as much as a human being is capable of saying. If you're me and it's the first time you've been up before 6 o'clock since, I don't know, since you had your mother had to change your diaper decades ago as a baby. The one last thing I would say is the U.S. and Singapore have a good treaty network, not just the free trade, but in connection with the U.S. FATCA rules, you know, the information reporting rules and so forth. And they have a companion intergovernmental agreement, ITA, which is, you know, a standard, you know, well-drafted, non-problematic treaty relating to information reportings. I did have the case of and I'm almost finished here, Roustam. There was a investment banking firm in London, and it was owned more than 25% by a U.S. citizen. So that triggers a variety of reporting obligations on the part of the company and on the part of the U.S. owner. And the London-based investment banking firm wanted to open up a bank account in Singapore. And this is the sort of the frying, as they say, mind frying, like frying chicken or frying vegetables. It fries your mind to figure out how that reporting obligations run. The Singapore bank said that the US-UK intercompany agreement applied. The IRS officer that I was working with, IRS, the US Tax Authority, said that it was the Singapore US AGI that applied, and the London bank believed something else. I don't know that it was just a crazy situation. So there's, just as with the interface of Pillar 2 and U.S. guilty rules, the rules relating to reporting are going to be a little bit of a challenge. So it's as the word snafu in English means a mess up or a problem, and it's a word that soldiers in World War II thought up, and it's an acronym. It stands for situation normal, all fouled up, although the word foul is not used. It's a more vulgar word that starts with an F. So situation normal, all fouled up would be a good adjective to describe the challenge of complying with Pillar 2, if that's relevant to your country, on the one hand, and the U.S. controlled foreign corporation rules, and the same thing with reporting obligations. Last sentence, the reporting obligations imposed by the U.S. government are complicated and require real expertise. Sadly, you'd think it would be rather straightforward, but there's a so-called 5471, a 5472. There's a foreign bank account reporting obligations. There are, they were put on hold by a U.S. court, but there are beneficial ownership reporting obligations that for sure will begin to apply within the next 6 months or a year. So there's a lot going on and a lot of work for tax experts in all the countries with which U.S. companies trade. And that's it. And thank you very much for allowing me the time.
Just a second, David. I want to dig a little bit further. So if I rephrase what you were saying, that the recent tariff measures and extra tariffs on supplies from China might result in the relocation of production facilities to other countries. Singapore, well, by definition, this is not the country which accommodate, I don't know, like millions of workers, millions of productions. It's just restricted in terms of territory, but it might accommodate some parts of these groups, like trading, like holding, financing companies. And if we think about purely hypothetical, we need, of course, the Singapore and local tax advisors to think about a relocation of production facilities from China to, let's say, Vietnam, and some extra parts of the structure being present in Singapore as a holding company, as a financing company. So from straightforward China, US, let's say the structure, we move to US, Singapore, Vietnam, and maybe some parts will remain in China. So
yeah,
much more sophisticated. Immediately, I think about transfer pricing issues, double tax treaty application, not only one tax treaty, but at least 4, with all this principal purpose test, with limitation of benefits, with so this is much more sophisticated structure than we might have seen now, and this is basically going to be the outcome of these rather simple measures, like increasing tariff. This is what I love about conversation with you. So with pretty much straightforward fact, you can make a very far-reaching, at the same time, well-grounded conclusion, which gives very useful insights. What would be your recommendation? Should we go to learn Vietnamese international tax law? What's the next step?
Would you believe that that's the first time anyone's ever asked me the question about whether someone should learn Vietnamese international tax law? So I'm going to have to think about it for at least half a moment. I right now am helping someone who had 100% of the manufacturing in China. They have now moved a lot of the production to Thailand. I mean, they're doing that right now. And under the customs law of Thailand, and insofar as it applies the U.S. customs law, enough of the production takes place in Thailand that it qualifies for, it has the status of an import from Thailand rather than an import from China, even though a good amount of the components and the production chain involves Chinese workers. So it's very fact specific. And then with the something that Trump just said yesterday about imposing reciprocal tariffs, that is a little bit problematic for this particular client. Thailand imposes a 10 or so percent customs on imports. So this client is at least going to, for now, they're just going to keep going with the Thailand thing, but they're going to take a look at Singapore, given that Singapore has a zero tariff between the US and Singapore, and see if they can integrate enough of their functions in a way that allows it to qualify as a Singapore good. In that regard, the transfer pricing is critical because it's a kind of opportunity. There's with many manufacturers, sort of maybe yes, maybe no in the case of this one particular client I'm working on now, so that you can base intellectual property in Singapore if that helps in qualifying a particular product being shipped from Southeast Asia to the US as an export from Singapore. So the transfer pricing, the underlying planning challenges are quite central to allowing manufacturers of goods to qualify for the zero tariff arrangement between Singapore and the US. So it's fact specific, very much so.
And one more question. I have heard the statements of President Trump that, guys, if you move production to the US, you are safe. If you keep it outside of the US, we do not know. Yeah, basically, that was the message in a very simplified way. I presume there should follow some extra tax incentives because from, let's say, recent 10 years short history of tax rates, I remember the tax cuts by Trump administration, then increase of tax by Biden administration, followed by the whole Pillar 2 story. And would it make sense to expect some further incentives in the US, specifically for the production activities?
Just looking at what actually happens, there's a lot of talk because you know, it's, the expression is it's red meat. It's very appealing politically to say all these things. But when the moment comes to pass a law and for the president to sign it, you know, it doesn't happen. It happens, depending on the issue, half the time, a quarter of the time, one time out of 10. I don't think that the federal government is not going, and this is my personal opinion, is not going to offer incentives that are apply across the whole spectrum of manufacturing activities with the eye to attracting them to the United States. It just is too hard to do. Having said that, there are U.S. states, you know, California, Texas, those states that often offer incentives for people to move their factory to that state. So it's possible that, you know, Texas or some country, you know, some other state will say, you know, we will buy the land for you and we'll give you 0% financing to build your factory in our state. And that sort of thing is possible, but that's, I don't know of anybody doing that or thinking about doing it right now, but that kind of thing is plausible. I think that, like, again, this client just gives a very good sample for these issues, the one that I referred to a moment ago. They're just not moving to the you know, there just isn't any place in the US where this company could have their product manufactured. There's portable appliances like humidifiers and air conditioners and things like that. So it's going to be, if it's not going to be China, it's going to be Indonesia or Thailand or Vietnam or perhaps, you know, Bangladesh. I don't know. and they're just going to have to deal with that. I'm just thinking ahead. I know what their price structure is and where they sell it. You know, they sell at Home Depot, big national chain, retail chain in the US, and they sell online. I guess if everybody is affected by this in the same way, then that everybody has the same disadvantage, whether it's this company or General Electric or LG in Korea. They're all going to have the same problem. So I can't give a firm answer. I think it's not going to be the U.S. government providing incentives. I just can't even think of, not that my thinking of it or not thinking of it is dispositive of the issue, but I can't think of an instance where that has been attempted. And it just isn't plausible. You know, the whole manufacturing base in the U.S.'s output of manufactured good as a percentage of GNP is actually higher than it was 20, 30, 40 years ago. But the number of factory workers has gone down significantly because in the US, it's all very high value add manufacturing functions, you know, high information technology factor and so forth, highly automated. It's just a different world, and it's going to stay in. You know, when it comes to manufacturing humidifiers, the Southeast Asia just owns that, you know, owns that sector. There's going to be a role played by Mexico in that, but I think just at the margin.
Okay. Well,
I am not an expert in these things. These are just me having, you know, keeping up with the news, making my own judgments on them.
Okay, so nobody is going to hold you liable if federal government will decide to offer some tax incentives. So no worries about this. And we put it in the recording. So
okay, well then I'm going to do I'm also helping people expatriate. So I'm going to expatriate to a country where I can't be sued for that. Okay.
Okay, good. Well, guys, that was a joke, of course. Not to say that somebody is going to sue you, but
yes, I understand.
Just an exchange of thoughts. Well, thank you very much, David. It was extremely helpful to hear your comments on these matters. Once more, I underline that all people who you heard during the last 3 hours are parts of the community of Leiden alumni. The participation in the program is one of the ways to get into this community, and well, by itself, this is not like a ticket to elite society, but this is just an opportunity to communicate with wise people, like all the speakers you heard this during this session. If you would like to proceed with improving your international tax knowledge, feel free to enroll into this program. There are not that much time left to subscribe. Just continue trying.
Roustam?
Yeah.
May I just mention something? I apologize. It's a little self-interested. I'm planning to take a trip to Singapore and Indonesia because of the Leiden connection. There's some of my classmates that I became very friendly with, and I'm working on a project with them, and I'll be in Indonesia and Jakarta sometime in 2025. If any of the listeners know a good coffee shop in Jakarta and want to just say hello, if they could contact you and then put us in contact.
Oh, absolutely. It's very good that you mentioned this, and we can organize some live event through our WhatsApp chat, through our connections, because in the first part of our presentation, there are many high-ranked Indonesian alumni, friends of ITC Leiden, including Ministry of Finance officials. So I'm sure you will have good advisors in Indonesia in respect of coffee shop and maybe more interesting things to attend. Thank you very much, David. Thank you very much to all the participants of our discussion this morning. I'm tempted to say marathon. Forgive me my accent. Very useful. I learned a lot of things. I'm sure all attendees learned something useful. The idea is to continue these meetings and knowledge sharings. And I'm very thankful to all of the speakers and attendees of this event, which I found quite successful. Thank you very much, David. So you can continue your rest.
Okay, thank you. I will.
Okay.
That I predict will happen.
Thanks. Bye.